The truth about your paycheck is far darker than you've been told. Every month, when you see that deposit hit your account, there's a fleeting sense of relief. You worked hard, maybe skipped a night out, paid your bills, saved a little, and perhaps even tried investing. You tell yourself that financial security is just a few smart decisions away. But what if I told you that the system is quietly designed to siphon off your earnings while keeping the richest people untouchable? To see how this works, we need to go back in time. Modern banking didn't start to protect workers or their paychecks. It began as a tool to consolidate wealth for those who already had it. These early bankers weren't interested in helping peasants or laborers. They were designing systems where wealth naturally accumulated at the top. And that blueprint hasn't changed much in over 500 years. By the 19th century, banks had grown bigger, smarter, and deeply entwined with governments. But in reality, they gave a small elite the power to control money supply, interest rates, and financial policies. When the economy boomed, the wealthy profited enormously. When it crashed, the burden landed squarely on the shoulders of everyday workers. History shows time and again that ordinary people carry the risk while the rich are insulated. The nightmare for salaried workers quietly began to intensify in the 20th century with the rise of credit. Credit cards, personal loans, and mortgages started as tools for convenience but quickly turned into traps. Banks realized they could generate enormous profits from small, recurring fees, late payments, overdraft charges, compounding interest. While wealthy individuals had access to cheap capital and could even profit during deflationary cycles, salaried workers were locked in cycles of debt. Often, they ended up paying double or triple the original amount they borrowed, without ever realizing how much the system was working against them. And this isn't some accident, it's engineered. Financial institutions employ teams of economists and data scientists who meticulously study consumer behavior. They know exactly how much debt a worker can safely take on, how often they'll pay late fees, and how much interest will accumulate over a lifetime. Meanwhile, the ultra-wealthy use tax laws, offshore accounts, and complex investment vehicles to grow their wealth while paying minimal taxes. Essentially, the system functions as a giant sieve. Money quietly flows upward, and salaried workers get trapped at the bottom, barely aware of the invisible extraction. Take the 2008 financial crisis as a case study. Millions of middle-class families lost their homes because banks had packaged risky mortgages into securities and sold them as investments. When the collapse hit, ordinary workers faced foreclosure, job loss, and ruined credit scores. But the banks, they were bailed out using taxpayer money. Executives continued to receive massive bonuses, and wealthy investors remained insulated. The lesson was brutally clear: when risk is socialized, profit is privatized. The system was designed to protect the rich and punish the rest. Even before 2008, signs of this system were everywhere. In the early 2000s, financial products became increasingly opaque. Adjustable rate mortgages, payday loans, and high-fee mutual funds drained salaries in small, almost invisible increments. Workers believed they were making sound financial decisions, but over time, a growing portion of their income was diverted into bank profits rather than building real wealth. Decades of careful observation, adaptation, and exploitation by the wealthy pushed the middle class closer to financial precarity. Central banking policies only worsened the situation. Quantitative easing, interest rate manipulation, and inflation targeting are often presented as necessary tools for economic stability. But for salaried workers, they quietly erode wages. Inflation slowly devalues your paycheck, while asset inflation stocks real estate, investments, and enriches those who already own them. For a worker earning a fixed salary, this feels like creeping stagnation. For a wealthy investor with diversified assets, it's a windfall. Fees are another tool banks use to quietly extract wealth. Overdrafts, account maintenance, and ATM fees seem trivial individually, but when multiplied across millions of accounts, they amount to billions in revenue. Banks call it service, but it's essentially a wealth transfer mechanism. Compare this to the wealthy, who pay little to no fees on investments and enjoy returns on capital that compound exponentially. The difference isn't luck, it's structural and deliberate. Even our retirement systems contribute to the problem. High-fee mutual funds, 401k management fees, and insurance markups chip away at long-term savings. Over decades, these small percentages can translate into staggering losses. Meanwhile, hedge funds and private equity funds catering to the wealthy charge performance fees and enjoy tax advantages that turn small percentages into enormous profits. Ordinary workers, unknowingly, are subsidizing the wealth accumulation of others. Modern credit systems have refined this extraction. Credit scoring, payday loans, and revolving credit allow banks to personalize fees and interest rates, often to the disadvantage of salaried workers. Algorithms analyze every behavior, assigning costs based on predicted ability to pay. Workers unknowingly pay more because of how they're profiled, while the wealthy leverage these same systems for near-free access to capital. Technology hasn't leveled the field, it's amplified the advantage of the rich. Even digital banking and fintech follow the same pattern. Microloans, digital wallets, and subscription-based financial apps promise convenience, but their fees quietly drain users. Robo-advisors claim low-cost investing, yet hidden costs remain. Meanwhile, wealthy individuals access private banking, exclusive global investment opportunities, and tax optimization software unavailable to the average worker. Technology hasn't democratized banking, it's sharpened inequality. Public perception is carefully shaped. Media glorifies financial success stories and frames debt as a personal failure. You're told to budget better, save more, or pick up a side hustle. Rarely is the structural manipulation, central bank policies, bank practices, and financial engineering acknowledged. The average worker is made to feel responsible for losses they can't control, while the wealthy continue to exploit the system's hidden advantages. The data is staggering. In the United States, the average household pays thousands annually in bank fees. Credit card interest rates often exceed 15 to 20%, while savings accounts for the average person yield less than 1%. Essentially, workers are paying to hold their own money. Meanwhile, wealthy clients access interest-free loans or borrow at nominal rates to multiply returns on investments. The system isn't just unfair, it's engineered for inequality. These consequences ripple through society. Wealth concentration and stagnant wages suppress consumer spending and reduce social mobility. Financial stress contributes to health issues, strained relationships, and long-term insecurity. Meanwhile, financial elites wield political influence, ensuring future regulations favor their interests. The cycle perpetuates itself methodically, quietly, invisibly. Fintech has introduced new extraction methods. Microtransaction fees, algorithmic lending, and behavioral nudges encourage workers to make choices that maximize bank profits. Meanwhile, the wealthy leverage technology to access tax-advantaged structures, exclusive markets, and high-return investment opportunities unavailable to ordinary account holders. The digital era has amplified the divide, rather than bridging it. Why don't governments stop this? Lobbying and regulatory capture explain a lot. Banking and finance wield immense political influence, shaping rules, tax codes, and enforcement in their favor. Ordinary workers rarely have a voice. When crises hit, governments stabilize the system, often with public funds, protecting banks while leaving workers to absorb the fallout. This pattern is global. From Europe to Asia, salaried workers face subtle wealth extraction and stagnant incomes. Central bank policies disproportionately benefit investors, and even countries with strong social welfare systems can't fully counteract these structural advantages. Wealth extraction is not just an American problem, it's engineered inequality on a worldwide scale. Attempts to fix the system exist: fee caps, consumer protection, and financial literacy programs. Yet these measures are often circumvented. Payday lenders adapt, banks innovate new fee structures, and complex financial instruments remain largely unregulated. For every reform, a new extraction method arises, perpetuating the illusion of fairness. The impact is measurable. Wealth inequality is at historical highs. The top 1% controls more than the bottom 50% combined. Salaried workers, despite decades of effort, see minimal real wage growth. During crises, they experience immediate and devastating losses, while the wealthy often profit. The system is built to protect and expand top-tier wealth. Understanding this system is crucial. Saving alone won't suffice. Investing without awareness can be dangerous. Relying on conventional banking may work against you. Awareness allows you to make strategic choices, protect earnings, and build wealth effectively. Knowledge becomes a survival tool. The warning is stark. Never assume the financial system works in your favor. Every transaction, every loan, every fee compounds over time. Wealthy individuals have optimized strategies to leverage these structures, while ordinary workers unknowingly participate in systems designed against them. Recognizing this difference is critical to financial resilience. So, what can you do? First, understand fees and extraction mechanisms. Study compounding interest, hidden costs, and banking policies. Second, explore alternatives, high-yield accounts, low-fee investment platforms, credit unions, and multiple income streams. Third, question assumptions. Hard work alone doesn't guarantee wealth. Understanding and manipulating the system does. Ultimately, this story is about more than money. It's about power, control, and systemic design. It challenges assumptions about fairness and forces us to rethink how we engage with money. Awareness, strategy, and vigilance are essential. The system was designed for inequality. Your survival depends on understanding it. If this resonates, take action today. Review your bank accounts, question every fee, and educate yourself about how wealth is protected and accumulated. Share this knowledge. Real change begins with awareness. The question is no longer whether the system works, but whether you're working it in your favor. Remember, your paycheck is more than numbers. It's a reflection of a system with winners and losers. Understanding history, mechanisms, and patterns gives you agency over your financial life. And that knowledge, above all, is the real wealth.